All right. Good Sunday afternoon, everybody. This video here is going to discuss some of the frustrations that a lot of folks have with the market right now. Look, you got the S&P 500 up almost 17% year to date, um, post the July 4th holiday week, kicking off a really strong July already, something that we have heralded in the past with our insights and our data. You got the NASDAQ up more than 20% year to date, but most investors, their portfolios don't look like that. You've got a lot of, I would say the vast majority of investors underperforming, and, some significantly. They might not even be up 5% for the year. And when you look at the market, you find yourself wondering why that's the case. Well, that's what we are going to kind of flesh out here in this video, as well as discuss what, some of the things that we think at Finom Group you should anticipate going forward. Speaking of anticipating going forward, our Finom Group members should know by now that I'm about to take my vacation this coming week from the 10th of July through the 15th. Be back in the driver's seat on the 16th. So hopefully this video will give you something to think about while I'm out of office, as they say. So with that being said, let's dive into it. Many investors have become quite frustrated by the stock market's performance relative to their own portfolio performance. 2024 is one of those years whereby most stocks are underperforming the indexes themselves by a great deal. It's a stock market year, not a stock picker's year. In truth, it's been that way for the last 18 months now. This is why they say trend following is tough. It's tough. Nonetheless, our first graph here from Ned Davis Research, or our first chart, kind of explains this very unique aspect this year. On pace for record low percent of stocks beating the S&P 500. This is where we are this year. You can see that's the lowest level, or the lowest percentage of stocks beating the S&P 500. And this data set goes all the way back to 1974. Now, that's the headline. And what do I always preach to our Finom Group members? I say, don't go to the headline. In fact, if you can, avoid the headline, because there's often more than meets the eye. And our eyes are trained to, look at charts. They're looking at the verbiage. They're looking at the headline. And sometimes we're going to miss something by doing that. So naturally, we know, all right, this so far is a record-setting year when it comes to the percentage of stocks beating the S&P 500. That doesn't speak to market concentration. Don't get the two confused. This is simply about what's performing and what's not. It's not a stock picker's year, folks. It's a stock market year. If you're in the Qs, if you're in the spider, if you get the majority of your assets there, you're doing quite well with the index ETFs. But if your portfolio is littered with Disney, PayPal, IBM even, although IBM's been doing well for the last year and a half or so, but just individual stocks, you're probably underperforming the market. I've long since said, the evolution of investing gives us the opportunity to market perform. Our human nature, our ego kind of gets in the way of that, right? We all want to be the world's best stock picker. Why? Why are we doing this to ourselves? Stop it. Get out of your own way, folks. ETFs are here for a reason. They're not going away. All right, so with that said, we know the headline now, and we know what's going on, right? It's just not a stock picker's year. But what you might miss by looking at this is these These years where you've had, basically minimal stock performance, outperforming, if you will, the S&P 500 itself has been up more than 20% for each of these minimal performing years. And remember what I said, this has been going on for a good 18 months now, where most stocks are underperforming the benchmark. Last year, same thing. Last year was one of those minimal performance years for stocks, not the stock market, but stocks. Nonetheless, every single time we've had one of these minimal performance years, I've jotted down, I've annotated the S&P 500's total annual performance. Back here in 1980, up 26%. 1990, I guess that would be 98, 26%. 99, 20%. And of course, last year, up 25%. Is the year over? Right, we're up almost 17% on the S&P 500, and people are complaining about, just how few stocks are beating the market. Fine, go get your spider ETF, shut up, stop crying, and catch up to some degree with your portfolio, because more than likely, based on past precedents, the market's going to challenge being up 20% or greater this year. All right, moving on. That's the big picture, by the way, right? We get the headline is kind of narrow scope. The big picture is, what actually happens to the S&P 500 throughout the year when most stocks are, and be careful what you wish for. So far as it being a stock picker's market, some of the worst years in history were when most stocks were beating the S&P 500, i.e., let's blow this up a little bit. Look at 2000, right? Most stocks are beating the S&P 500. 2001, most stocks are beating the S&P 500. Fast forward, here's 2008, 2009. Be careful what you wish for. Get on board with ETFs already. Okay, so another frustrating thing, we know that most stocks are not keeping pace with the S&P 500 or the NASDAQ 100. But we also know that mid caps, right, small caps, equal weight S&P 500, they're all underperforming. Here's the chart of each of those. This is the mid cap S&P. This is the small cap Russell 2000 IWM index ETF. And this is the equal weight S&P 500. Notice they all have the same bull flag pennant formation. It is no coincidence that these three areas of the market have similar performances over the last 18 months. I mean, look at the charts. Same troughs, and that same rises, same dip and rip, dip and rip, same dip and rip, right? Small cap S&P, small caps themselves, mid caps, equal weight S&P 500. I mean, that's basically the whole market absent large caps, right? Large cap growth. This is essentially the rest of the market not performing. They all have these bullish, pennant flag formations. These are the areas of the market that are underperforming, which one could also include the value ETF, right? That's another area of the market, value. You can get the value ETF ticker symbol. It's underperforming as well. The key variable to the performance is rates. Why are all these areas of the market underperforming? Well, large caps they're not sensitive to rates, right? They've got clean balance sheets. They got a lot of cash. They generate a lot of cash, especially if the economy is in expansion mode and not recession. So their balance sheets can basically stave off any kind of rate hike cycle or higher for longer cycle. But as you go down the cap tier, stocks become more and more sensitive to those higher rates. Mid caps, small caps, so on and so forth. Equal weight S&P 500 obviously is giving basically 1 point to every stock. And most stocks are small or mid cap stocks. Most. So equal weight is going to underperform as well. The bull flag pennant formation lends itself to remaining optimistic, right? I mean, this doesn't look great, and we know it's underperforming. There's threats of double tops here, but the reality is we're finding bases for all of these bull flags. We're finding bases. Why won't they break down? That should be the question, really. And I'm sure we're going to explore that. The failure of the breakdown is in favor of a protracted sideways pattern, is likely due to the same range-bound price action that's happening where? In the 10-year Treasury yield. This is a chart of the 10-year Treasury yield going back to last year, or a one-year chart. And as we can see, it's basically just trending sideways. Ever since it hit that peak here in April, when we had that pullback in April in stocks, it's fallen down. It's failed to make new highs, but it's basically gone nowhere since February, right? We are right back to where we were here in February. So if this is going sideways, right, we just can't get, these can't get unstuck. They're not breaking down because we're not breaking out in the 10-year, but they're not breaking out either because we're not breaking down in the 10-year, right? Something's got to give, and eventually we'll know what that is. Is it going to be yields breaking down and the rest of the market breaking out, or vice versa? Yields breaking out and the rest of the market finally breaking down. Our first chart of the breakdown segment will headline the greatest stochastic for measuring, it should be, a broad market breadth, the NYSE Common Stock Only Summation Index. Why not just use the summation index, Seth, for the NYSE? Simply put, the NYSE is more than just stocks. It's bonds, it's bond funds, it's international ETFs or international funds. It's not just stocks. And we want to get to just stocks. What's the momentum, the breadth momentum for stocks? So we're using the common stock only summation index. And as we can see, it's at the lowest point of the year. It has started to curl up a little bit here, but I wouldn't make a whole lot of that until we actually break to the upside. We've had some curling in the past, and in the more recent past, yet we've found lower lows. So broad-based breadth momentum is at the lowest point of the year and in negative territory. It's not as bad as it can get. I mean, you can drop off the face here and go down to 1,000 negative, but yeah, that's not where we are, obviously. So let's see here. As we can see from the chart above, this is the first negative reading of 2024, although it has been trending down since early May or mid-May. Yes, if you've already moved ahead, right? If you've already moved ahead of our conversation here, you likely know that this is precisely when or where those areas of the market in question began their descent, right? Right around mid-May. Let's see. Indeed, here we are, mid-May. They're all the same, mid-May. Mid-May. Most of the market is not moving higher, right? I mean, most stocks are moving lower. Hence, broad market breadth has been moving low. Broad market breadth momentum, I should be specific. All right. Let's see. The concern from here is widely speculated by investors and financial media. What happens, right? What happens if we're going into earnings season. What happens if large cap growth, tech, Qs, right? The NASDAQ 100 finally pull back. consolidate, maybe even a full-blown correction, right? Without the other areas of the market proving to participate, won't the whole market fall apart or go into, a textbook definition of a corrective phase? It's possible. But here's what we've noticed recently, and this chart is from Frank Capillari of Cap Thesis. It's a fantastical tracking of what has taken place since that 5% pullback in the S&P 500 in April, right? So pretty much by mid-April, when we've been having these daily declines in the S&P 500, look at the percent of stocks that were up in the S&P 500. 52% of stocks were higher on this 0.2% pullback. 67% of stocks were higher on this almost 1% pullback on April 19th. May 30th, 0.6% pullback. 72% of stocks were trading higher that day. The majority, even in June, when you had these pullbacks here on the day, most stocks were higher. More than 50% of stocks were higher every single time. The best performing sectors during these minor pullbacks are listed in this column. The worst performing sector during these pullback days is in this column. What does this tell us? People don't want out of the market. If the market itself is going down, they're just rotating capital into other now value opportunities like real estate, like utilities, healthcare, energy. So if you're worried about the market breaking down, if tech, growth, large caps fall, most stocks have actually held their own, if not risen on those days. This helps kind of put a put underneath the market. This tells us the market can only go or should only go down so much because investors don't want out. They're okay saying, all right, my large cap's not working right now. My Qs, my tech, my semiconductors aren't working right now. Let me see where I can find value. And this is where they're finding it. So it shouldn't come as any surprise if we don't get a full 10% correction this year. People don't want out of the market. They're probably going to gravitate not just into sectors, but into other areas that they find of value. You have small caps trading at valuations in an expansion cycle, mind you. They are trading at valuations that they haven't traded at since the pandemic in 2020 and before that, the dot-com era. That's deep value for small caps. Doesn't mean they're going to get up and go right away. It just means don't be surprised. But what has to change? That's another question, right? Because right now we're in this regime. There's a trade in the market. And that trade, brother, it doesn't include small caps and mid caps in equal weight. There's a trade in the market, and that trade favors large cap growth, NASDAQ 100, tech, semiconductors. Software has even gotten a bit of late. So what has to change? And here's the other thing, why I mentioned small caps earlier. We saw the chart of small caps and the bullish bull flag pennant formation. This is this is the earnings for the Russell 2000. Russell 2000 year-over-year growth rates. We went through 5 straight quarters of negative earnings in small caps. Mind you, small caps have underperformed in each of the last 2 years coming into 2024, and they're possibly going to underperform for 3 straight years. Go figure, right? I mean, their earnings have been horrid. However, look at the expectation for Q2. This is the Q2 estimate for 2024. This is supposed to be the first earnings growth quarter that small caps have seen since Q4 of 2022. And by the way, what outperformed in 2022? Small caps beat the S&P 500. Well, maybe not so much. We'll get into that. Nonetheless, there's supposed to be this ramp. These are the estimates: 13.8% year over year earnings growth, 35% in the Q3 period, Q4 period, it just keeps getting better, 54%. If small caps don't get going soon, you're going to be looking at the cheapest valuation for small caps in history. Do you think the market makes it that easy for investors? I've been doing this for 25 years. Rarely has it been that easy. Doesn't mean it can't happen. I'm just saying rarely has it been. Market doesn't like to give you a gift. Let's put it that way. The market likes to inflict pain, okay? So these are your fundamentals that are looking good. But remember, this is 2 weeks ago, right? This is from 2 weeks ago. Rewind, hit the pause button and rewind. 2 weeks ago. Now fast forward to this week's upwardly revised estimates. Q2 estimate 2024. It's now up to 19.5%. 13.8, it's now up to 19.5. That's almost 40% in a week. And yes, small caps underperformed last week. They were down on Friday. I think they were down for the week, but don't quote me. Either way. And then it ramps up to 63% and 89%. What are we talking about here, folks? What we're talking about is a likely put beneath the market. Because if these estimates become realized through the earnings season that we're about to embark on, more than likely, if large cap stocks have already priced in the good earnings that are expected from them, they may pause. You may see investors rotate out of those large cap growth names, Magnificent Seven names, into other areas of the market. May, no guarantee. And like I said before, markets don't like to hand out gifts. These are the fundamentals you need to better understand. And when we're talking about a breakdown of the whole market, fundamentals say it's less likely. The trend of rotation says it's less likely as well. This is the percent of S&P 500 companies with positive 3-month percent changes in forward earnings. These are not, I repeat, not estimates from analysts, but rather positive 3-month percent change in forward earnings established via the guidance offered from the S&P 500 companies themselves. We are currently at the peak and highest level of the cycle in the positive 3-month percent change in forward earnings. This doesn't happen with just the Magnificent Seven carrying the weight of the earnings burden. In fact, the top 10 companies in the S&P 500 make up 35% of the market cap, but only 23% of actual earnings. That means 77% of earnings come outside of the top 10 companies in the S&P. 77% of those companies are contributing to this. Earnings are expected to go up, and more than likely, that's going to be realized. Right now, analysts are calling for an 8.8% year-over-year Q2 earnings growth period. Don't be surprised if it's closer to 10%. We'll know more, obviously, in the coming weeks. Should we be surprised that the market has performed as it has in 2024? Maybe a little, given it is the best first half of a presidential election year in history. right? We're making history here. But should you be surprised directionally? I don't think so. Right now, we have earnings growth that is accelerating with GDP decelerating. How does the market generally perform? Quite positively. In fact, when you have these two dynamics in place, 78.8% of the time, the market is trending positively. Data goes back to 1950. So we're talking about the entirety of the post-World War II period. Almost 80% of the time, when earnings growth is accelerating and GDP is decelerating, the market is trending higher. And you say to yourself, well, Seth, don't we want, better GDP, better economic growth? In the environment that we're in right now, you actually favor slower growth simply because it'll help with the overall inflation regime. Slower growth, less pricing power from the vendors, from the wholesalers, from those big brands, the Nikes of the world, the Starbucks of the world, General Mills, your consumer staples, right? You don't want them to have the pricing power that they've become accustomed to. If you have slower growth, they're going to have to start discounting more and more and more. And we've already been seeing that. McDonald's, value menu, Wendy's, you have all these kinds of deals if you have the Starbucks app. So yeah, it's modestly slowing economic growth, but it is still slowing economic growth. All right, let's move on. Want more evidence as to why we think a breakout in breadth and broad market participation will likely occur if the Fed lowers rates? The following table is from Charlie Bolello, and it might help. So what the table depicts is the absolute and relative performance of the S&P and Russell. This is the S&P's performance since 1979. Why 19? Because that's when the Russell came about. And here's the Russell's absolute performance. Now, their relative performance is this column here, S&P minus the Russell, and you get your performance. The red shaded years are when the S&P is underperforming. The green shaded years are when the S&P is outperforming. If we fast forward 2011 to 2024, year to date, the S&P is outperforming the Russell by 15.4%, which is the greatest outperformance since 31% right there in 1998. If we closed up shop, if the year ended today, this would be the greatest S&P outperformance relative to the Russell since 1998, or the dot-com era. Pretty remarkable stuff. Not only is the outperformance greater this year than last, but the Russell will have underperformed the S&P 500 for 1, 2, 3, 4 consecutive years by year end if something doesn't change in the back half of 2024. So ask yourself this question. What is the current macro fiscal policy regime label? It's simple, right? It's higher for longer, right? We've heard that drumbeat now since July of last year. The Fed is going to hold rates higher for longer. And with a possible soft landing already captured by many of the standards related to past rate hike cycles that did not end up in a recession. When we recognize those standards, we do officially have a soft landing. People don't like to accept that as fact, but it is a fact. Nonetheless, now study the table once again, folks. When did the multi-year S&P 500 outperformance formally dominated the Russell 2000? 94, 95, 96, 97, 98, right? So for 5 consecutive years, the S&P dominated the Russell. We're up against 4 right now. Now, what's so special about this period that might be akin to this period? For those of you that know your market history, 1994, with some hindsight, because they were still calling for a recession in 95, was a soft landing, right? The Fed had hiked rates and basically stopped hiking rates in 95, but held rates higher for longer until 1998. And they slightly lowered rates. So this was the higher for longer period. What do we have now? A higher for longer period. So what does this basically tell us? It tells us that small caps are very sensitive to a higher for longer period. But the market, right? Small caps are also telling us that this is probably a soft landing taking place. When did the multi-year performance dominate? Okay, indeed, during the 1994 through 99 soft landing episode. Coincidence? I think not. The only real difference is the Russell's prior underperformance here. That's really the only, and that's a byproduct of how quickly the Fed had to hike rates. This was not a rapid rate hike cycle. This absolutely was in 2022. So you basically have had higher for longer for 2 years, right? We first started hiking rates in March of 2022. We're in July 2024. It's a little more than 2 years we've been in higher for longer. This is about rates, folks. Rates are the determining factor here of why you're getting this underperformance in the rest of the market in most of stocks because of the higher for longer. You can basically just tie a bow on it. That's what's going on here, folks. But what if the Fed doesn't cut rates in time? What if large cap growth tech cues pull back, correct before the Fed cuts in the coming months? And that's a fair question. But I'll remind you, market so far has loved to rotate, not to correct further. The other thing is we're looking at some fund flow data, and you're looking at the seasonality of the market, which is dominated by fund flows. Here's technology. You worried about technology, pulling back? It's been up. The technology ETF has been up for 14 straight years. It delivers its best monthly return in the month of July. It's already up 3%. The average return is 4.6%. It has not delivered a negative return in 14 years or going back to 2009. Fund flow data that we talked about in our weekly research report a month ago warned, if you're bearish, you're pointed in the wrong direction with your portfolio. Flood of cash from passive equity allocations will pour into the stock market in early July. What are passive allocations? They're your 401ks, they're your pension funds, they're your mutual funds. They're automatically allocating capital to the markets. Why do you think we started out so strongly here in July? So I get it. I mean, we can correct, we can pull back. And, even the bulls, I think, would want that at this point. But it's probably going to be short-lived. Earnings are going up at in an accelerating manner. That's why the market can't quite keep up with its own self. It's trying to price in future earnings, let alone the here and now. Here's some quant considerations I want to leave you with for the week. The S&P 500 has achieved 34 new all-time highs in 2024 to date and is on pace to achieve 70 new all-time highs if it replicates the first half of the year in the back half of the year. The all-time high for all-time highs in a calendar year is 77 back in 1995, the higher for longer period. The other interesting thing is that all-time highs achieved in July continues to inform that the top for the calendar year has never been made in June, which we've talked about in the past, but also July has only been the top once since 1980. the odds are, if we keep, making new all-time highs in July, more than likely that won't be the all-time high for the year. The market has only topped once in the month of July since 1980. Here's another one, because people started getting worried about, why are utilities? Utilities are sending a message. The market's getting very defensive. Utilities are one of the most defensive areas of the market. But they were one of only two sectors that were higher in the Q2 period. The other one, of course, technology. One of only two sectors. But here's the thing. You had a 4-month win streak. I'm sorry, I think, 4-month win streak for utilities, which ended in May. And it's happened, it's going back to 1990, 1, 2, 3, 4, 5, 6, 7, 8, 9, 10 other times. S&P 500's performance going forward, 1 month, 8 times it's been up, 2 times it's been down. Well, one month later was actually June. The S&P 500 was up in June. So you can scribble in 9 times up, 2 times down. We'll find out what happens at the end of this month, but 2 months later, historically, when you've had a 4-month win streak in utilities, the S&P 500 has never been down, never delivered a negative return 2 months after that utilities performance streak. 3 months later, perfect 10-0. 6 months later, 10-0. 1 year later, 10-0. And this study comes to us from Nautilus Research. So this is telling us the probability that the high will be made here in July is really low. And this is telling us that the high in July, being the high for the year, is really, really low. What about this coming week, Seth? Right? Will the pullback start this week? We've got really, important data coming out. We've got the CPI on Thursday. We've got PPI on Friday. That's the inflation data. Like, that's front of mind with the Federal Reserve, Seth. True. Wayne Whaley's latest study, NASDAQ and the S&P 500 performances from July 8th, Mondays, so July 8th through the 15th, right? That'll basically take us into those earnings results from JP Morgan, Wells Fargo, and Bank of America, or Citigroup, due out on Friday. So when the trailing quarter, so that's April 8th through July 8th, is up at least 5%, and right now, I think, let me see, is this April 8th through, right, as of right now, that quarter was up 12.91%. More than likely, it's going to be up, more than 5%, given there's only one more trading day in that quarterly period. So after that happens, historically, the July 8th through 15th, this coming week, July 8th through the 15th, the S&P has been up 22 times, only down twice. The NASDAQ has been up 17 times, only down twice. The probabilities that the market will pull back starting this coming week are low. Of course, that economic data could prove exogenous to this study. But again, the odds favor more upside for both the S&P 500 and NASDAQ. Well, Seth, you talked a lot about rate hikes. So I'm sorry, rate cuts. I guess I've become accustomed to, rate hikes. That's just the first thing that comes to my mind and my tongue. So we've talked a lot about rate cut potential going forward. If I was asked, Seth, do you think that the Fed's going to cut this year? My answer is yes. I think that by September, the data will assuage and give the Federal Reserve enough confidence to at least cut for the first time here this year. And that'll be after the July meeting and, of course, Jackson Hole in August. So September, I think, is the first opportunity that the Fed will have, unless something goes wrong with jobless claims over the next coming weeks. We see a massive spike in jobless claims after already getting above 4% in the unemployment rate. That can throw a monkey wrench into the whole picture here. But I don't think the Fed should cut before September, regardless. We typically do have a spike in jobless claims, which we've already seen at the end of the school year. Literally happens every year, but people get all up in arms. Even with that spike in jobless claims are down year over year. So that's why I say, even if we do get a bit more of a spike in jobless claims the next couple of weeks, I don't think that's the right thing for the Fed to be responding to, after, also seeing the unemployment rate get above 4%. I think that would be a misstep. Nonetheless, there's a lot of people out there saying, yeah, the market's already priced in that rate cut, Seth. The market's already priced in several rate cuts. Well, historically, that's just not the case. Here is the market's performance ahead of the first rate cut. As you can see, stocks average about a 10% gain in the 6 months before a soft landing rate cut. And here's what happens after that rate cut. The next 6 months, the next 6 months, the market's higher. So no, this is like pouring gasoline on a fire. Rate cuts are like gasoline being poured on the market's uptrend. You don't have to like it. And, this also shows a bit of a correction here. That could be fears that the Fed is cutting because too many investors believe that the Fed is trying to stave off some kind of economic slowdown of consequence, i.e. a recession. Usually that just proves a growth scare. Results in higher prices. Now, here's something else I want to talk about. Our price target for the S&P 500 has already been hit. Again, our price target coming into this year was 5,200 to be achieved by June, which happened, right? That's basically the first half of the year. We hit 5,200 in the first quarter of the year, for which we raised our S&P 500 price target for the year to 5,400. Which, yes, has already been hit and surpassed as well. In lieu of, a hard and fast year-end price target, what I'd be more comfortable with, looking at the earnings picture and a lot of the dynamics surrounding the geopolitical environment going forward, as well as the trend in overall economic activity, I would say I'm more comfortable with a 5,900 price target by June of next year. Now, there's the high probability that between now and year end, all of the data that we look at on a week-to-week basis, not just what we're discussing here in this week's video, but other data that we are disseminating throughout the week and talking about in our Finom group daily trading room, there's every indication that the market could achieve 5,800 by the end of this year, which brings us back to this analog that most of you might recall from 2020. In 2020, we used this analog related to the 2009 analog. This came from inside of our August State of the Market report. Now, most of you who know your market history recall that the 2008-2009 bear market bottom happened in March. Well, the COVID bear market bottom happened in March as well. And from that COVID bottom, it basically was taking the same path as the great financial crisis market bottom. So by August, when it was still on that track, we said to ourselves, what if we project this out to year end? Where would that put the S&P 500 at year end? 3761 is where it would have put the, we said this in August. In December, the last week of December of 2020, the S&P 500 hit 3761. It ended the year at 3756. Folks, when I tell you fund flows matter and these analogs matter, this is the evidence. Oh, but, oh yeah, but she, and that guy, and what about the Goldman, and what about, Piper Sandler and all these different firms, and JP Morgan still says 4,200, Marko Kolanovic, he just left his job, and I don't care. I don't have the ability to care what all these people say. The market is governed by fund flows. It's why we disseminated these notes in the past. You can call it seasonality till you're blue in the face. Seasonality is dominated by fund flows. Funds flow this way at this time of year because they do. If you want to know why they are flowing this way, have a ball. In fact, report back to me. Give me all the bullet points. I'm more than happy to let somebody else waste their time doing that. But fund flows are the seasonality. They are scheduled to do, and that's why you get these repetitive cycles. And that's all we had back here with the 2009-2020 analog. After a great collapse in the markets, funds coalesce to deliver basically the same thing every time. And wouldn't you know it, ever since then, we've been on the same path. 2009 analog in blue and today's in the red. The only difference, as you can see, we squared it off here. The only real difference was 2010. Why? Oh, come on. I think I'm stalled out here. Oh, okay, low battery. Let's make sure my charger's in. Maybe we can get something going here. Okay, no. Give it a minute, folks, because I'm not sure it's recording. Well, I'll keep rambling in case it is recording, which I hope it is. But the only difference is squared off in this box here, and that was 2010. For those of you who know your market history, you know what happened in 2010. You had an anomalistic event, right? You had the flash crash. So you had that big correction in 2010. It's the only difference. It's also why I say usually something has to, if we're going to get a recession, it's usually been an exogenous event. If there's going to be some kind of massive disruption in the market, it's usually some kind of exogenous event. 9/11, great financial crisis, COVID, these are exogenous events. The only thing that can be a man-made exogenous event is the Federal Reserve's monetary policy. That's it. Nonetheless, even after this flash crash separation in the 2009 and post-COVID analog was, that 2009, but everything else has been precise, including, 2012 versus 2011, 12 versus 2021 and 22, right? Here in 2011, remember back in 2011, we had the European debt crisis. And that kicks off 2022, where we had, wouldn't you know it, Ukraine-Russia war, inflation spikes, and we've got, a Federal Reserve that has to, participate with monetary policy. Here's the other thing as we look out to 2025 that you need to consider. This is not going to last, right? Are we really going to have two back-to-back years of 20% returns, 20+% returns in both the S&P and the NASDAQ? Yeah, probably. Not guaranteed, but probably. What about 3 years? What about this analog? Not likely. Not likely. In the fourth quarter of this year, and we're going to talk more about this, once we get to the fourth quarter, next year's going to be tough. In fact, I'll go on record as saying it's going to suck. It's going to be an absolute suck fest. And yet the market will finish positive next year. What do you mean, Seth? Next year, third year of a bull market. 2009, 2010, 2011, third year of that bull market. Absolutely sucked. We had a 19+% correction in the S&P 500, 25% correction in the NASDAQ. It's gonna suck. S&P 500 barely finished positive that year. The average year 3 of a bull market return, 5%. You're not going to have a lot of fun. We might also have a new president. And please don't take this as a political statement, okay? We know if it is going to be Donald Trump, we know what his first term presidency was like. If you were an investor back then, market didn't close at 4 o'clock. It didn't open at 9:30, right? You had extended hours where you were active because there was tons of volatility after hours and pre-market. Number 2, the policies of that administration were actually sowing the seeds, if not the foundational roots for inflation. That's where it all started. COVID built on it. And the policies since under the Biden administration have built on that. But it did, in fact, all start during that first term presidency of the Donald Trump White House administration. Remember, it was the first time in more than a decade, or maybe a decade, that we had any degree of wage inflation. We also had a much lower migration from South America. So we had, unfortunately, wages went up. When you don't have that influx of immigrants taking those lower wage jobs, wages go up and it starts that inflation cycle. And some of that was predicated on, and don't get me wrong, some of the policies are working still. Some of the policies need to be paid for at some point in time. That's not to say Mr. Biden's policies haven't been paid. No matter what administration we've had since the turn of the century, we haven't paid our bills, period. That's why I say, don't take this politically. It doesn't matter if it was a Democrat or it was Republican in the White House. We're not paying our bills, okay? But we know what to expect out of a Trump administration or a Biden administration. We are likely going to still see some lingering effects of this inflationary regime, which again did start basically in 2017 with the signing of the Tax Act, and then the trade war, then COVID, then supply line issues, then the war, and the inflation, spike in all commodities. So we're likely going to still see those lingering effects. It doesn't mean that we won't slowly edge closer to the Fed's 2% target. It just means might be even slower under a new administration. that is pro-growth, but growth at what cost? It might be inflation. It might be higher rates, even if they settle down to, let's say, 3.5%, 4% Fed funds rate. These are all the things you might be impacted by in 2025. It'll be interesting. It will be interesting. All right, with that, keep this analog in mind, folks, which takes me back to, or probably sets the stage for my final comments. As you can see, if we do complete this analog from 2009 to 2013, as of 2020 to 2024, we should be anywhere between 5,750 and 5,800 on the S&P 500 by the end of the year. Analogs can be disrupted, but usually they're not. So we're looking for 5,900 in the first half, by the first half of next year. If it happens sooner, good, fine, great. If it doesn't, it's just a price target, folks. We're going to have a lot of discussion on how to manage your portfolio ahead of 2025 and how to possibly position ahead of 2025. And of course, with the remaining half of this year, we want to extrapolate as much of the bullish trend out of this market as possible. You know, are we going to see that rotation into small caps, mid caps, equal weight, value? We know what it's going to take. We know there's a trade in the market right now that does not include small caps, mid caps, equal weight, and value. What's going to change that? We know what's going to change that. It doesn't matter that the 10-year yield has dropped from 4.75 down to, let's call it 4.25 recently. It doesn't matter because the 10-year is also range bound. So you haven't seen an improvement in performance out of those areas of the market that have underperformed because investors know something has to give. It's either the 10-year giving with rates moving lower, or it is the 10-year staying range bound and the market stays, you know, as it has been the remainder of the year. I'm doubtful, you know, that the Fed won't cut rates at least once this year, which does set up the probability of small caps, mid caps, and equal weight breaking out at some time by year end. If not, because the Fed has lowered rates, then because the value is simply too hard to ignore by that time, and the excessive value of large cap growth, tech, semis, Magnificent Seven is too excessive. With that, I hope you've enjoyed our weekly video. I'll be on vacation, but please don't hesitate. Send me a direct message. This video won't go out to the public probably until Tuesday of the coming week. If you are not a Finom Group member, sign up, subscribe, get all of these insights in real time. You can be a contributor member and get all of our research, all of our videos, our weekly macro market reports, our third-party research. If you want to be a premium member, you get all of that, plus you'll get our trade alerts, our investment ideas, our daily trading room access. We discuss all of this subject matter on a daily basis. Have a great trading week, everybody. Be safe. Take care until next time.